Welcome to the SA Residential Wrap. I'm Sarah, and we must apologize. We really can't say Gauteng properly. Our AI voices just can't get it right, and it drives our found Len van Niekerk crazy.
And I'm David. South Africa just hit its 3% inflation target, exactly on target. And within days, a Middle East oil shock reminded us why that achievement might not survive the quarter. This week, what the building data tells us about a supply crisis that no rate cut can fix.
We're covering the past couple of days that started with genuine domestic progress on inflation and closed with a global energy market, reminding us exactly how fragile that progress is. Today, the CPI story with a catch, hard new Stats SA supply data that reframes the Western Cape narrative, where NISFA stands on direct payment reform and a building pipeline.
Rate orientation. Prime is at 10.25%, unchanged since November. The MPC meets on the 26th of March, which as we record is essentially now, and the consensus is a hold. The can-do house view is prime on hold in the near term, with any second-half cuts now genuinely uncertain. The oil shock introduced upside inflation risk the March BER survey didn't even capture. Fieldwork closed on the 5th of March, before the price escalation.
And that's the February CPI irony. We get the 3.0% print, exactly the SARB's new point target. And almost immediately, the conditions that produced it start reversing.
Medical aid contributions account for 8.4% of the total CPI basket. Several schemes delayed their January premium increases, knocking the February print lower than it structurally should have been. Fuel was down 3.1% in February, then reversed sharply when oil prices escalated during our reporting window. So 3% is real, but it is not the clean structural signal it looks like at first glance.
Stats SA published January 2026 building completion data on the 19th of March. Flats and townhouses completions, measured by construction value, collapsed 36% year-on-year. Total residential completions were down 9.1%. And this is against a backdrop where national plans passed are running 45.4% below the 2018 peak, and still declining, 33,060 units nationally for all of 2025.
The mechanism matters. Plans passed lead completions by 12 to 24 months. The completions bounce we saw through 2025, up 15.4%, looks like recovery. It was a lagged echo of 2022 and 2023 approvals. Developers working through an older backlog. The forward pipeline itself is still contracting, so completions will follow it down, with a lag.
What does that mean for the high-density urban stock that build-to-rent and private student housing depend on?
It means we are heading for a structural supply cliff. The demand-side stimulus is real. Rate cuts partially transmitted. The CGT primary residence exclusion now live at 3 million rand, professional inflation expectations at a record low. But you cannot cut your way into supply. The 12 to 24-month transmission chain from plans passed to completions is physical. You cannot bypass it with financial engineering. When you press the demand accelerator against an inelastic supply chain, the feedback loop is predictable. Asset price appreciation and yield compression on existing stock, not volume expansion. Institutional investors already holding completed build-to-rent and student housing assets in well-located nodes are positioned to benefit asymmetrically from this over the next 18 to 24 months.
And the CGT change is now live, which adds another dimension. The primary residence exclusion has moved from 2 million to 3 million rand from the 1st of March. That does stimulate secondary market movement, long-held assets in the 3 million to 8 million rand band becoming more liquid. But we keep saying it because it bears repeating, CGT relief applies to resales only. It does not pour a single foundation or add a single new bed to the national housing supply. Demand-side stimulus meeting inelastic supply produces the same outcome regardless of the policy lever used.
Provincially, Gauteng is dragging the national pipeline by 5.7 percentage points, nearly 5 billion rand of negative impact. Municipal infrastructure dysfunction is the primary driver. The Western Cape is contributing a positive 3.3 percentage points, which confirms the governance premium is real and structural. But that positive contribution is partly the Western Cape drawing down a reserve, not adding a new one, which brings us to the barb. But let's hold that thread.
Just look at the value of total residential building across the country in real terms. That is, after we strip out the impact of inflation in constant prices.
The trend is alarming. Both the real value and the long-term trend in plans passed and completed have been declining since approximately 2018. In real terms, we are at levels last seen in the early 2000s and not far above the COVID-induced crash point.
And there are no signs of sustainable recovery in either.
No. And when taken with the inflation, interest rate and global economic uncertainty because of the war in the Middle East, I don't see much of a recovery in the short to medium term.
There is one silver lining, though. For investors and landlords, supply isn't flooding the market, at least not at a national scale, and that may help them keep rental growth up, provided the market that they are serving doesn't also come under too much pressure. In a previous episode, we discussed how the formal managed rental market has undergone a significant shift. The affordable bracket, rents between 3,000 and 7,000 Rand a month, has shrunk from over 60% of the market in 2013 to 44.5% today. The middle-class rental bracket has more than tripled in size.
The theme seems to be the safer middle over the more economically sensitive lower market, including the NISFAS market.
And that means the overwhelming majority are still going to struggle with accommodation.
Until we have policies together with real delivery by government to unlock broadly defined government land and on-time payments on one hand, and a clearer global and local economic outlook on the other. Yes.
Tomorrow, we will unpack the residential square meters that have and are being planned, and a specific look at Gauteng and the Western Cape. And they very interesting.
The BERQ1 2026 Inflation Expectations Survey has a structural story buried in it that matters for mortgage origination. Professional forecasters, financial analysts, business executives, trade union officials are converging at 3.6% as their inflation expectation for 2026 and beyond. That is a record low for this survey series. The analysts' subgroup alone sits at 3.3%, very close to the SARB's 3% point target. It signals that the people responsible for capital allocation and wage negotiations regard the new target as a credible medium-term anchor. That is genuinely good news for long-duration property assets and for the development economics that underpin build-to-rent and senior living viability.
But household inflation expectations moved the other way.
Up from 7.7 to 8.4% over 5 years. So the people who need to sign 20-year home loan agreements are operating on an inflation expectation nearly triple the official target. The mechanism: when potential buyers perceive inflation at 8.4% while borrowing at 10.25%, their perceived real rate looks very different to what the data shows. They hold cash, they defer, they rent rather than commit. And the February CPI whiplash, the print that looked like a landmark, immediately followed by oil escalation and widely reported medical aid delays, reinforced exactly the kind of household skepticism that drives that deferral. This psychographic friction on mortgage demand will not clear until 3% is sustained for several consecutive quarters without this kind of energy price whiplash. The Middle East escalation has meaningfully set back that timeline.
Today, we are going to dive into this a little more. Who's generally better at getting inflation expectations right? Analysts, households, or trade unions? These expectation numbers from the BER survey do carry weight with the SARB because interest rate policy is not only affected by current conditions, but by what the market is expecting, because those expectations drive behavior in price setting and hence inflation itself.
Yes, for example, trade union inflation expectations are doing to drive wage demands.
And household expectations show landlords what consumers are expecting and could form a basis for what they think they can push residential rentals by.
Households are always too pessimistic. They think the worse and actual inflation comes in lower. The further into the future, like the 5-year view of 8.4% we discussed, the more pessimistic and wrong they get it.
So what you're saying is that household 5-year expectations current at 8.4% at the start of this year, that is way above the SARB target of 3%, and that we shouldn't pay too much attention to that.
Basically, yes. The SARB, with a 3% target, is not going to raise interest rates now because households expect longer-term inflation at 8.4%. Households will hold cash, defer, and rather rent rather than commit. That holds. While their inflation expectations may not weigh too heavily on the SARB, it doesn't mean that those expectations won't drive behavior.
Who's better at getting it right, trade unions or analysts?
The short answer is analysts, but only just. Average annual inflation since 2010 was 5.2%. Analysts on average got it bang on, 5.2%. Trade unions, 5.5%. Only a slight difference.
What's interesting is how they got it wrong and what that past pattern might mean now.
Yes, analysts have tended to be conservative on both up and down cycles, except of this time. Between 2010 and 2015, inflation was generally rising. Analysts were too conservative, predicting worse than actual in the inflation upcycle. On the other hand, the broader inflationary cycle was down from 2017 to 2011, and analysts were initially too bullish, then too conservative. And between 2021 and 2023, they were consistently too conservative, forecasting higher than actual.
How has the period from 2023 to the present evolved? We have been in a broadly disinflationary environment, which has supported the rate cuts observed.
Analysts have been getting it wrong, but in a different way. They have consistently been too optimistic. Look at the chart.
Hang on. If what you say holds, when considering the oil price shock and the fact that the last survey was done before, that it means that their expectations of 3.3% for 2026 is wrong and too low.
Exactly. If they out by half to 1%, it means that we are looking at actual of 4 to 4.5%, which would be in line with what has played out over the past 4 years.
But the SARB target is 3% with a little give either side of that.
Yes, our house view is that we, looking at an average rate through year of around 4 to 4.5%, and that rate cuts are on hold. And if the US Fed starts to hike rates, we see a potential that the SARB may even increase rates later on in the year if we see inflation sticky above 4% for a couple of months in a row.
Wow, that's 180 degrees different to what the consensus was.
Yes, but I think we will see a shift in analyst views on rate cuts. Initially, the message will be rate cuts on hold. Then we could see talk of potential increases around July-August if we're seeing inflation above 4%. But I think that all central banks, analysts, and consumers are hoping for the best.
Neither hope nor fear are a strategy.
No, frankly, we don't know. But the inflationary pressures have built and are building. An exogenous shock, something external over which we have no control with a very uncertain inflationary future. What we could see is funders and investors taking more conservative approach. Remember the lag.
Yes, between development projects getting the go from developers and investors and them coming onto the market. Typically, 6 to 12 months between when a developer starts and a project is initially marketed before being built, and about another 18 or so months and the keys get handed over to buyers and tenants, meaning 2 years or so between a project being a serious development opportunity and physical delivery to the market.
Correct. And that means that we could see tighter supply, especially for the likes of new student accommodation. Yes, there are some new projects, there almost always is, but the supply of stock to the screaming requirement for NISFAS market stock is not going away.
NISFAS have already told investors and developers that you aren't getting an escalation this year and that the accommodation allowances aren't increasing this year and that you are going to have just absorbed the inflationary costs in your margins.
Yes, together with the other operational pressures caused by late payments, defunding, etc., means that the requirement and demand for affordable student accommodation for the vast majority of students is not going to be met, and that we will see a generally more conservative view emerging from developers and investors to bringing on more stock on the market.
The caveat remains the infrastructure islands. We talked about that in our last episode. Infrastructure islands such as Waterfall in Midrand Johannesburg are likely to keep attracting buyers. This segues us to our next discussion, Stats SA building data and the supply issue. We've tracked the NISFAS payment crisis across several episodes. This period brought structural progress on the reform side and no movement on the underlying affordability problem.
The reform. NISFAS has confirmed direct payment of accommodation providers for 2026, eliminating the solution partner intermediaries that caused chronic delays in 2025. By late last year, approximately 400 million rand in historical backlog had been cleared for 2024 and 2025 claims. First semester 2026 funding was promised for release by late March. For accredited providers who have been carrying cash flow risk for months, this is a real structural improvement in income predictability.
And the cap picture?
Metro private cap, frozen at 52,000 rand per year, 5,200 rand per month over the 10-month February to November disbursement window, 0% increase for 2026. The non-metro cap was raised 15.5% to 49,282 rand a year, about 4,930 rand per month on the same window. That non-metro increase is meaningful and signals NISFAS acknowledging that costs outside major metros have risen materially. But the metro freeze is where the volume of demand lives. The sector advocacy body SASAPA, noting this is their estimate, single source, puts the actual cost of delivering compliant housing at around 66,000 rand per annum.